Good morning. I'm Eric Parrado, Chief Economist and General Manager of the Research Department of the Inter-American Development Bank. It's my pleasure to welcome you to the virtual public launch of the 2020 edition of our flagship Latin American and the Caribbean Macroeconomic Report. This year's report is titled Opportunities for Stronger and Sustainable Post-Pandemic Growth. Those of you that read the report every year will notice that this year's is probably the most comprehensive and ambitious report of the series. In part, this is a response to the current exceptional situation, as these are perhaps the most challenging times facing the region. The idea was to provide an assessment of what has happened, but perhaps most importantly, to provide a set of concrete recommendations. The region will emerge from the COVID crisis poorer, more indebted, and with economies that will look very different in terms of their productive structures. This year's macro report covers more than the standard macroeconomic issues because the nature and magnitude of challenges are significant. Yes, we need fiscal, monetary, and financial policies to preserve stability and to boost sustainable and inclusive growth. And we covered those topics in the report, but we also need reforms that will help reduce informality, address low productivity, enable small and medium enterprises to invest and grow, hire more workers, export more, and build stronger economies. We also need to boost growth and making it more sustainable. And we cannot forget the growing climate crisis, even as we deal with the coronavirus crisis. The report contains chapters on each of those additional issues, treating them with equal rigor. This COVID-19 crisis began to unfold as countries were already facing a complex set of pre-existing conditions, including low levels of productivity and similar social discontent. Perhaps a fitting analogy to describe the situation would be that in 2019, the region was flying with one broken engine. In 2020, its other engine also took a hit. The challenge we now face is to fly these aircraft to safety, rescue the passengers, and prepare for the necessary repairs. I presented this year's macro report to the IDB governors in the IDB annual meetings in Barranquilla, Colombia, 2 weeks ago. It helped us to start a conversation with governors about the risks and opportunities that lie in the road ahead. I hope that today's presentation will further contribute to that endeavor. Today's presentation will be carried out by the report's coordinators. Andy Powell will focus on what has happened, summarizing some of the different implications, and then Eduardo Cavallo will present the main recommendations. The presentation will be about 20 minutes, and then we have two distinguished guests who will provide comments. We are very honored to have Teresa Terminacian, former director of the IMF Fiscal Affairs Department and longtime collaborator of the IDB on fiscal issues, and Claudia Cooper, president of the Lima Stock Exchange and former Minister of Finance of Peru. Both Teresa and Claudia have gracefully agreed to comment on the report and share their insights. We're very fortunate to have them and grateful to them for accepting this invitation. Some housekeeping issues. First, we have interpretation in English and Spanish, so you can choose the language of your preference using the word symbol down in the Zoom screen. Second, the chat is open, so you can post your questions, comments, and greetings. So with that, Andy, the screen is yours.
Thank you, Eric, for that introduction, and good morning to everybody. I want to start this presentation actually by thanking the team that helped to write and put together this report. There were a team of authors from different departments of the IDB that wrote the different chapters. So as per previous Latin American and Caribbean macroeconomic reports, this was really a very strong team effort. And we were also helped by economists from across the IDB who provided further inputs, and a fantastic group of research fellows and an excellent production and dissemination team. So I really want to thank everybody who was involved in the different aspects of producing this report. As Eric said, we're dividing this presentation into two parts. So I will talk first about the impacts of the COVID crisis and some implications, covering fiscal, monetary, and financial developments principally. And then Eduardo Cavallo will summarize the main recommendations of the report. I'm just seeing the first slide. Are we advancing the slides? So if we could go to the first graph now. Latin America and the Caribbean was one of the worst affected regions, with only 8% of the global population, but unfortunately, the region has suffered more than 25% of the global deaths from COVID-19. And unfortunately, as many of you are acutely aware, the war against the virus is still not yet won. And in fact, outbreaks are still surging in some countries. Considering the data on deaths and 2020 growth across countries, it's striking that there's no real trade-off between saving lives and saving economies. In other words, countries that suffered more deaths also lost more in terms of economic output and vice versa. The region likely suffered badly due to the weak health infrastructure, the patchy enforcement of lockdowns, high levels of informality, and insufficient connectivity to be able to work from home, among other factors. Some countries, of course, suffered more than others. Actually, countries dependent on tourism were particularly hard hit in terms of economic output, so they lie above the trend line that you can see on the graph. And some of the larger countries in the region were particularly hit in terms of deaths per 100,000, so they actually lie below the line. And unfortunately, the crisis has implied deep losses in employment, an increase in inequality and in poverty. In one simulation, extreme poverty is projected to increase from 12.1 to 14.6%, while moderate poverty is projected to rise also from 11.7 to 14.6%. So only a strong recovery will allow these rates to decline significantly in the months and years ahead. For the region to be able to bounce back, this will depend, first of all, critically on resolving the health crisis. This figure illustrates a baseline consistent with the IMF's latest projections, with 4.7% growth for the region in 2021, and then reverting to trend growth of about 2.5%. But in a negative scenario where vaccines are delayed, or there are new mutations that could even be resistant to vaccines, new lockdowns would then be necessary, and that would inevitably delay recovery. 2021 growth might be 1.2% in this simulation. And those new lockdowns could even prompt a double dip or a W-shaped recovery, as illustrated in the graph. So it's a very difficult time, of course, to make any kinds of growth projections. And as I said, it's very critically dependent on resolving the health crisis. But there are also some upside risks. China will grow very strongly this year. And with the new additional stimulus, the US is also likely to exceed the previous expectations. So both, of course, both countries are extremely important as trading partners for the region. But in the US, there's fear that inflation may pick up, and then the Federal Reserve may be forced to change its patient stance on interest rates, and that could prompt a financial market correction. But still, if the vaccine rollout is relatively smooth and we can continue to open economies, and the financial market correction is mild, then there would be net benefits for the region. And in a more positive simulation, growth could be 5.6% per annum this year. The stronger world growth has already triggered a rebound in commodity prices. In fact, prices are above the pre-COVID levels for several commodities, including soya and copper, which are, of course, both very important for the region, for the agricultural and metals producers. And oil prices have also risen considerably. Turning to fiscal matters, countries implemented significant fiscal packages in response to the crisis, including above and below the line items. In Latin America and the Caribbean, packages averaged 8.5% of GDP, but more than 1/3 of IDB borrowing countries had more limited packages of about 3% of GDP, or even less in some cases. And we should compare this to the average package in advanced economies of 19% of GDP. So as a consequence of those packages, primary fiscal deficits rose from about 0.5% of GDP in 2019 to almost 5.5% in 2020. And the overall fiscal deficit rose from 3% to 8.3%. By comparison, in the global financial crisis, overall deficits increased from about 0.4% of GDP in 2008 to 3.2% in 2009. So the fiscal response this time around was much more significant. Countries are spending about 3% of GDP on interest rates. on interest payments, that's about 13% of public sector revenues. And countries are devoting a total of about 5% of GDP to service debts. That's interest payments plus amortizations. That 5% is roughly twice the investment in infrastructure in the region in recent years. Gross debt is on the rise. In 2020, it rose to about 72% of GDP. And in a central scenario, we expect it to rise to 76% by 2023. And that assumes that there will be a recovery and a significant fiscal adjustment as recovery takes hold. Again, by comparison, between 2008 and 2009, debt rose by just 3% of GDP, from 41 to 44%. If recovery is delayed or fiscal consolidation is more gradual, then of course debt ratios would rise faster. So countries are in a difficult position. They are trying to navigate a path, supporting families and firms on the one hand during this crisis, but at the same time maintaining fiscal sustainability. Obviously, countries are in different positions, and for some countries, this path is becoming narrower. So it's really the time to think about how to make fiscal reforms and how to improve fiscal outcomes. Eduardo will talk more about the recommendations in that line further in the presentation. Turning to monetary developments, most central banks in Latin America and the Caribbean have managed so that inflation rates have been low and stable across the region, and independently of various monetary regimes that are in place. Of course, there are some exceptions. And in some countries, for some goods such as food, inflation has been on the rise, perhaps reflecting supply disruptions and indicating that demand is quite strong. Central banks have been active reducing interest rates, but as demand returns and inflation picks up, they will have to reconsider their monetary policy stance, and some have already taken actions. Central banks have also reduced reserve requirements, and their balance sheets have expanded, extending liquidity to both banks and to governments. For 3 central banks, the expansion of the balance sheet was more than 10% of GDP, so not an insignificant amount. And central banks will likely need to pare back their balance sheet expansions as recovery takes hold and the exceptionally high demand for liquidity fades. These actions, in tandem with public guarantees, have supported credit. And credit has actually risen in most countries, credit to the private sector. Banks came into this crisis with high capital and liquidity ratios, and policies that have been implemented have cushioned the impacts on the crisis. But loan moratoria and loan reprogramming are likely hiding risks. In this report, we suggest there may be a growing disconnect between standard balance sheet indicators of risk and more market-based measures. On the corporate side, we see that debt has increased worldwide and across economic sectors as firms raise large amounts of money from public and private sources. Latin America is no exception. In fact, corporate debt ratios have risen more than elsewhere. However, at the same time, spending on new investment has declined. So firms have accumulated significant fiscal cash balances to cover operational expenses and to prepare for further potential losses from the shock. Let me finish this part by talking very briefly about the external accounts. Exports fell, but imports fell back even further, and so current accounts have narrowed somewhat. This can be understood referring to the usual savings and investment balance, as while public savings fell, private savings have risen significantly and investment has fallen, with the net impact of a reduction in the current account, but also an increase in reserves. So interestingly, while at the start of the crisis, there was a lot of concern about sharp outflows in portfolio capital flows, actually, countries were able to access international markets and we saw very strong issuance from both governments and corporates through the rest of the year. In fact, it looks like 2020 was a record year for total issuance. Of course, good fundamentals, and in particular ensuring fiscal sustainability, will have the distinct advantage of being able to maintain access to capital markets, which will definitely help in the recovery phase. So with that, I'll turn the screen to Eduardo. Eduardo.
Thank you very much, Andy. Good morning. There are a number of policy recommendations that we recommend in this report. First, I will talk about recommendations related to fiscal issues, and then I'll turn to recommendations related to opportunities to boost sustainable growth. In terms of fiscal policy, one of the biggest opportunities for the region comes from simply spending better. Improving public spending efficiency could liberate significant fiscal resources. We estimate that up to 4.4% of GDP could be saved per year on average across countries, and even more in countries with high spending levels. This requires, for example, eliminating leakages in social transfer programs, which means targeting those programs better so the resources reach those that need it. And also eliminating up to 1.4% of GDP that is wasted on bad procurement processes for goods, services, and public investment. The region also continues to suffer from inefficient tax design and implementation, with considerable avoidance and evasion. If the region could match the tax effort of advanced economies, revenues would increase by 7% of GDP. In addition, there is room to increase the tax base in many countries. At 22% of GDP, tax revenues on average are considerably lower than the OECD's 34%. In many countries, a large portion of this gap is explained by poor enforcement. And also tax expenditures are very high at almost 4% of GDP. These should be reduced, if not completely phased out, as they are generally distortionary and quite regressive. Countries could apply these savings or additional revenues to, for example, increase spending on high-quality health and education projects for the benefit of poorer families. They could also reduce import tariffs on capital goods to enhance much-needed private investment, and address high poverty rates in the aftermath of COVID-19 through well-targeted additional transfers. And even finance more well-selected public investment projects, for example, in infrastructure. Multipliers of infrastructure investments are as high as 2, meaning that for every peso spent, GDP may grow up to 2 pesos. There is also a series of structural reforms countries should consider implementing to aid recovery. One is reducing informality, which is a serious problem that affects about half of workers and impacts both productivity and tax revenues. In the report, we discuss how the region can implement, for example, labor income tax credit programs like the Earned Income Tax Credit in the US, which is a well-known example, that reward formality rather than subsidizing informality. To successfully implement these changes, we also need the right fiscal institutions. There are 3 that have proven to be exceptionally useful, but are still uncommon in our region. A quality of spending unit within the government, a congressional budget office, and a productivity or evaluation commission. The combination of better spending, tax reforms, and strengthening fiscal institutions can improve fiscal outcomes, helping countries navigate the way out of these challenging times and resume economic growth. This allows me to turn into the series of opportunities that countries should take advantage of to achieve greater sustainable growth. One of them has to do with the reorganization of global supply chains. During the COVID crisis, some 56.5 billion or 6.1% of total US imports of intermediate goods switched to new source countries. As a comparison, Latin America and the Caribbean currently exports only about $26 billion worth of intermediate goods to the United States. This is an opportunity, particularly for small and medium-sized exporters in the region. However, the truth is that the region has not been able to tap into this opportunity. Our share of US imports of intermediate goods actually dropped as exporters, especially small and medium-sized firms, find it difficult to participate in global value chains on a consistent basis. Deepening regional integration should be a top priority. Harmonizing rules and ironing out inconsistencies in existing trade agreements could help boost regional value chains. It would also help firms compete in global supply chains better. Building strong business relationships is key to helping firms take advantage of global and regional value chains. Exporters often rely on imported intermediate inputs tailored to specific needs, which demands significant investments. Therefore, when an exporter loses an existing provider, it takes time to search and successfully establish a new relationship. As this figure shows, the larger the fraction of suppliers that were lost during the COVID crisis, the more negative was the impact on firms' exports. For those firms that lost about 20% of their suppliers, exports fell by 13%. On the other hand, firms that increased their suppliers by 20% saw exports grow. A similar pattern emerges when looking at customers rather than suppliers. Given the importance of maintaining relationships and creating new ones, it is critical to support business networks. Policies that provide logistical support, reduce transaction costs, online networks tailored for small and medium enterprises to connect with suppliers and clients like the IDB's Connect Americas, and other policies that help overcome existing gaps through targeted investment can all strengthen the resilience of exports networks. The region also has an opportunity to address the long-standing low productivity growth problem. COVID-19 has generated more output losses among labor-intensive sectors, which have been most impacted by the changing consumption and production patterns due to social distancing. But labor-intensive sectors are more malleable, meaning that they will likely recover faster. A challenge is that they should recover better to higher productivity levels. Now, despite the unprecedented nature of COVID-19 pandemic, the disproportionate impact on labor-intensive sectors is a common feature of crisis. We have analyzed the aftermath of systemic crises affecting the region over the past 3 decades. While these were mostly financial crises, the pattern is very similar. This table shows that capital-intensive sectors sustain less output losses when the crisis hit than the labor-intensive sectors. But labor-intensive sectors recover faster. The issue here is that the recovery should be to a higher level of productivity. That's what we should try for. And to be able to do that, we need to increase investment in sectors that have the potential to increase productivity across all economic sectors. A case in point is infrastructure. Investing in infrastructure builds up or improves the country's transport, energy, sanitation, and telecommunication assets, which has positive spillovers to other economic sectors and therefore to the entire economy. Increasing investment in infrastructure can boost productivity and growth. For example, if countries could increase productivity in infrastructure-related sectors to the level of OECD countries through more and better investments, then the economy-wide productivity could increase by 0.6 percentage points per year, which is equivalent to 75% more than what we achieved in the past. And according to estimates that we presented in another flagship that we published last year focusing on infrastructure, the DIA 2020, countries could also boost GDP by an average of 3.5 percentage points of GDP over a 10-year period if they take advantage of digitalization to increase efficiency in the sector. This represents approximately $200 billion of incremental output over 10 years. These benefits may be as high as 4 and 5 percentage points of incremental growth in some countries. There is another crisis facing the world which has not disappeared, namely our planet's climate. But this crisis also represents another opportunity. Technology has moved on, and we no longer need to choose between growth and climate goals. And it is even more urgent to tackle the risks of climate. With the pandemic, social and economic conditions have deteriorated and left the region much more vulnerable to climate change. Investing in sustainable infrastructure constitutes a win-win strategy, and it reduces climate risks while boosting economic growth. Implementing sustainable infrastructure plans could add 1.3 percentage points of incremental growth in Latin America and the Caribbean and create 15 million additional jobs by 2030. As this example of the Costa Rican decarbonization plan shows, the benefits of investing in sustainable infrastructure far outweigh the costs. The plan establishes a timeline for public transport to progressively switch to electric or hydrogen vehicles by 2050 and identifies immediate regulatory changes needed by 2023 to enable it. Implementing this plan will bring $41 billion in net benefits to Costa Rica between 2020 and 2050, equivalent to boosting growth by 0.4 percentage points. While the months ahead will be challenging, this report details a set of policies that should help countries realize a stronger recovery, not just to the low growth rates of the pre-pandemic period, but to higher rates of growth that will benefit all. This presentation is only a short summary of what is in our 2021 Latin America and the Caribbean Macroeconomic Report. We invite all of you to download the full report at the link that appears on the screen. Thank you very much, and I yield the floor back to Eric. Thanks.
Thank you very much, Andy and Eduardo, for the presentation. It was a really interesting summary of what we're trying to share in our macro report, which is really ambitious. So personal thanks to both coordinators, Andy and Eduardo. And now we have two distinguished guests, as I said in my introduction, who will provide comments. So I will leave the floor first to Teresa. So Teresa, you will have 10 minutes for your comments. Thank you very much.
Thank you very much, Eric, and thank you to Andrew and Eduardo for their very interesting presentation. Let me try to share my screen. I have a summary of the comments here that can be, seen. Okay, first of all, I really would like to thank my friends in the research department for inviting me to comment on the 2021 macroeconomic report. Over the last, over the last several years, I have routinely, I would say, enjoyed and benefited from reading these reports because they offer sound analysis of macroeconomic developments, trends, and emerging issues in the Latin America and Caribbean region, as well as a wealth of quantitative information. These reports really evidence the vast knowledge that the IDB staff has of not only the economic, but also institutional and social political realities of the region. And the 2021 report is no exception. Not only does it provide the customary thoughtful analysis of the macroeconomic and labor market outlook of fiscal, monetary, financial, and external policies, but also includes some novel data and analysis of more structural issues, as evidenced in the Cavallo's presentation, such as the region's integration in global value chains, the determinants of productivity, the role of investment in infrastructure, especially green infrastructure, in promoting faster and more sustainable growth. I agree with most of the report's analysis and conclusions. Therefore, I'm going to focus my comments on a few points on which I have some questions or perhaps some nuances in difference in views. First of all, the short-term economic outlook. Chapter 1 of the report discusses the short-term outlook, which, as usual, is based on the IMF's latest available projection. In its recent, just released actually, April WIO, the IMF has revised upwards its forecast for GDP growth for both 2021 and 2022 by 0.5% of GDP, but 0.5 percentage points and 0.2 percentage points respectively. This revision mainly reflects the carryover of a stronger than expected GDP performance in the region in the second half of last year, especially in Brazil, and the expected spillover to the Latin America region of the projected stronger growth in both the US and China in 2021. I certainly hope that this more favorable scenario does materialize. However, I am concerned that the slow rollout of vaccination in the region and the escalation of new infections, especially in Brazil, may force more restriction to mobility, or at least more reluctance by consumers to increase demand for services that require close human contact. Therefore, I would think it's prudent not to rely too much on a rosier outlook at this point. I think it would be better to be surprised on the upside than on the downside. The report highlights well the very difficult trade-off that confront the fiscal authorities in LAC at this time. On the one hand, there is a clear need to ensure a rapid deceleration of the escalation of the public debt over the last year, actually going even further than last year before, and its subsequent decline in the not too far future. Because as external financial conditions begin to tighten in the years ahead, hopefully only at a gradual pace, but this is far from assured, markets are increasingly likely to penalize emerging market countries that fail to put their public debt on a sustainable trend. On the other hand, spending pressures are likely to remain strong in some areas, including targeted social assistance, unemployment insurance, health and education spending associated with the pandemic and its aftermath. Such spending is clearly needed to mitigate a distribution of the burden of the COVID-19 that has exacerbated the already high levels of poverty and income inequality in the region. I would have liked to see in the report a clearer recognition, possibly an order of magnitude quantification of such spending needs until the pandemic abates and the sustained recovery sets in. The report correctly points to the substantial savings that can be gained through reallocation of public expenditures and through efficiency gain. It draws on the excellent work of the IDB staff in the flagship of 2 years ago, Better Spending for Better Lives. Some of these gains would require, as was mentioned by Cavallo, policy and institutional reforms that will take time to produce significant results. This adds, of course, urgency to beginning such reforms. Some gains could be obtained in the nearer term. The IDB staff has already made suggestions, and it certainly will continue to work with country authorities to identify such low-hanging fruits, given each country's specific circumstances and institutional context, and will continue to support their rapid implementation. Even so, I doubt that expenditure saving alone can create adequate fiscal space in the short to medium term to accommodate to both accommodate the new spending needs in the social and in infrastructure areas, and to begin reducing public debt to GDP ratios in most of the LAC countries. This makes it all the more important for the region to move forward with tax reforms that mobilize additional revenue in a way that is efficiency and equity friendly. As the previous work, not only by the IDB, but also by the IMF, the World Bank, and other institutions amply demonstrates, there is significant scope for broadening the base of existing taxes and for strengthening property and green taxes in Latin America. And although significant progress has been made in most countries in improving tax and customs administration in the last decades or so, there remains ample scope for improving tax compliance. The pandemic crisis should be viewed as an opportunity not to be wasted to move forward with such reforms that may be more politically difficult in normal times. I agree with the thoughtful analysis of the monetary and financial policies in the report. These policies and the flexible management of the exchange rate in most of the region's countries have helped cushion the impact of the pandemic on both GDP growth and the current external account, so far at little cost in terms of inflation. However, exiting from monetary and below-the-line financial support to firms will pose delicate challenges to the authorities, which the report identifies well, in particular as regards the timing and pace of withdrawal of postponement of loans and or loan services and of loan guarantees, and as regards the identification of firms that are unlikely to survive in the post-COVID environment and for which, therefore, financial support should be withdrawn soon. I agree that it would be desirable to ensure that the governments share on the upside as well as on the downside risks in their support to companies. However, I'm not sure that there is much scope, or at least extensive scope, for taking equity stakes in such companies as the report suggests. It would have been useful to explore other possible instruments in this area. The report stresses that, sorry, I forgot to move. The report stresses that COVID and other factors, including, the growing rift between the US and China, related disruptions in traditional global value chains in the last year, open new opportunities for the region to strengthen its participation in such chains, and it offers some policy recommendations in this area. I agree with the thrust of this argument, but I would also note that the structural weaknesses that have hampered this participation so far, in particular, the small size of most Latin American firms, logistical and infrastructure weaknesses, and the existing spaghetti ball of bilateral trade agreements with different features is going to take much time to correct. And also perhaps it remains unclear how much of the regional trade integration can be efficiently achieved as long as many countries remain primarily commodity exporters. So regional integration needs to go hand in hand, in my view, with export diversification. Finally, I've read with great interest the analysis of the relation between capital intensity and total factor productivity in chapter 8 of the report. I must say I'm not an expert in this area, but it struck me that the literature on TFP points to many factors that affect its level and development over time besides capital intensity. These factors, of course, include education and skill levels of the workforce, which are not generally captured adequately by data on the labor inputs. Institutional factors such as financial development, labor market flexibility, and the legal and regulatory environment for firms. If these factors are more important determinants of TFP than capital intensity, perhaps policies to address these shortcomings should be given priority. However, I certainly agree with the emphasis that the report places on beginning to seriously address the huge infrastructure gap that the region faces. Identifying the key bottlenecks in this area, preferably in a dynamic perspective that privileges the growing needs for investment in broadband telecommunication, decarbonization, adaptation to climate change, and mobilizing the necessary public and private resources to reduce these bottlenecks will be key, as the report suggests, to improving medium-term prospects for sustainable growth in LAC. I would like to emphasize on this point that it will be very important not just to increase infrastructure investment, but also to improve the systems for selection and procurement and implementation of investment projects. Because as we all know, we all have seen more than the region's fair share in white elephants in the past. Therefore, I think that the IDB can help countries together with the other institutions to improve investment processes and make investment in infrastructure really as productive in terms of growth as the econometric estimates mentioned by Eduardo suggest. Thank you very much.
Thank you very much, Teresa. As usual, very good comments. We are gonna consider all of them in some way or another. Indeed, we are working in several documents and flagships regarding all the issues that you raise in some way. So thank you very much again, Teresa, for sharing your thoughts. So now we're gonna have Claudia Cooper. She also has 10 minutes for her comments. Claudia, the screen is yours.
Okay, thank you, Eric, for the invitation. I just wanted to comment a few things. I'm glad of actually watching that Latin America has been the worst affected region by the COVID. I think that actually had an explanation of we had like a mistaken diagnosis that there existed a trade-off between the economy and health. And that trade-off actually was a common knowledge in our countries whenever all these very strict quarantines were implemented. And I think that trade-off actually may exist if you have very high quality governments. And probably if you analyze Europe, that can actually be an issue. But in our countries where informality is large and the quality of the governments is not properly developed, what you have is that health was not properly attended. We didn't have the health infrastructure to attend the ones that were actually hit by the COVID. So what we had was actually very strict quarantines without having the capacity of the state to attend those that were actually hit by the disease. So what we did is that we applied all these measures in governments that were not able to attend the fact. So that was, I think, a mistaken diagnosis at the beginning. The other thing that actually the study actually emphasized, and the presentation of Andrew actually had one chat about it, is that the increase in poverty was lower in the countries with high fiscal and monetary space. I mean, countries like Peru and Chile, for example, that had, very strong fiscal and monetary institutions, were actually the ones that were capable of implementing the largest monetary and fiscal expansion. And that, I think, had an impact on the poverty increase. We actually managed to limit the poverty that will have increased if we didn't implement those fiscal and monetary expansions. And what we also saw in those two countries is that probably the recovery of growth was faster as soon as quarantines were relaxed. So the question that remains is what will happen when all these spaces fade? What happens, especially Peru, I don't know, and Chile probably, and the rest of Latin America that had some fiscal and monetary space are running out of space. So we don't have that much capacity of continuing implementing those expansionary fiscal and monetary policies, especially fiscal ones, because there is a sort of structural reduction in the fiscal strength in the countries that were better equipped to do that. So what we have is we don't have that more space, and if we have new waves of the disease, we probably won't have that fiscal and monetary capacity to counteract the effects in the economy that will have. So the other thing is those, especially in Peru, we had a huge guarantee programs through the banking sector. So what that happens is that at the moment, everything looks fine because we are actually in the middle of the companies are not required to pay the loans yet. So what we have, and there's a discrepancy probably between the bank's balance sheets and the reality of the companies. So the real dimension of the effect of the COVID will be seen when all those periods of grace actually start being terminated. So there is, we'll see probably in the quarters ahead. So we have been able to limit, to actually recover the economy fast because we have implemented very ambitious fiscal and monetary policies, but that's almost, I mean, the space isn't there, probably the space isn't there yet, so isn't there anymore. So what we'll see is probably that this recovery that was very, very auspicious in the past quarters, probably we'll see what happens when they start to fade. The other thing is I saw is the external sector. External sector looks pretty healthy in our economies, and that's because mainly investment has been diminished. So, and we always see the current account deficit, but we didn't watch that much the financial deficit of the balance of payments. And probably what we'll see there is an exchange from FDI towards the capital inflows from governments getting more debt. So it's much healthier for external accounts to have equity to be, invested in a country than that being actually that debt increases, because that makes our balance of payments much less flexible. So there is debt that we still will have to honor in the future, while usually FDI is a much more flexible way of financing external accounts. Looking at the recommendation, there is always, all our countries need improvement in spending efficiency. And that's a very, very hard task to achieve, because it's not a matter of just policy. We need to improve institutions there. We've tried to do that many times to improve the quality of our spending. And that has not been probably as successful as it should, because there is a problem of the quality of the state, of the capacity of the institutions of making that improvement. The other issue is the tax effort, and I think there is a trade-off between increasing the tax collection and not affecting the competitiveness of the country. And it's something, that balance should be made, because there is nothing that actually reduces tax collection more than a growth rate that diminishes. Growth is a very, very, whenever the growth, the elasticity of the tax collection towards growth is very high. So if you don't grow, tax collection is going to be affected. So that equilibrium between we need to collect more taxes, but we need not to damage the competitiveness of the country that much. So it's something that we should take into account if we want to take a successful tax policy that we will need to actually finance our deficits in probably this year or the next one at the most. There is a room for national resources, and many of our countries are very rich in natural resources, mining, oil, or agriculture. So there is and those prices are going very well. So it will be interesting to make the forecast of how the deficits are going to be in the quarters to come, by including a very, very benign scenario of prices on that issue. So let's have on natural resources on those companies the way of trying to get as much as possible on tax income from them, and not punishing them by reducing their capacity to produce. So that's something that we have to take into account, because we'll need that money very much in the quarters to come without hurting competitiveness in our countries. I agree completely that we have to improve our global supply chains. But I want to emphasize what happens with the domestic supply chain. In many of our countries, we have two worlds. We have the very large or corporations that are very productive, that they compete worldwide, and they are also labor intensive, and they are going to do well because they have a huge productivity. But they actually share, they live near by near with these very small, unproductive companies. And there are two worlds that are completely separate. We need to actually make the connection between the two. I think formalization can be much more successful if we try to make those value chains between the large and productive corporations that are going to be productive and that we are probably going to be able to grow, and try to actually take those small enterprises and be able to develop them in the future. So those two worlds have to be connected more. And large productive companies they have probably a space to make those small companies that are usually suppliers for them, that can develop and grow with them and get more formal and hire more formal labor. Because there is to say, the labor market in our countries are structurally damaged. Good jobs have been destroyed by this pandemic very highly, and trying to recover it only through fiscal and public measures is not going to be possible. We need the private sector to start constructing new formal labor again. Is not only, just making the government do it is not going to be possible. We need the private sector to do that, and to do that is actually, we need the big companies to try to have some sort of something to do in order to make formalization into their smaller suppliers something much more effective. There is the other thing in formalization is the role of technology. Whenever digitalization is going to be a very, very effective way in trying to formalize small SMEs, small companies. And that's because probably all the invoices, everything, if you do that digitally, it will be much more easier for the tax authority to collect taxes, and to collect those taxes in a very simple way. I think that if we'll try to make a tax policy that actually is based on a very complicated normativity and is trying to probably attack the competitiveness of the country, is not going to be that effective. Let's make simple rules that actually make people easier to know what is the tax obligations they have. There's the higher tax rate is the one that you don't know. If you actually face these complicated norms that will affect the capacity of these firms to actually know what is the tax that they are finally going to pay, that uncertainty is the highest complication we can have, not only in collecting taxes, but also affecting the competitiveness of the country. I think digitalization has also a very, very nice role in the development of financing, and the capital markets have a huge role there, because it's a very effective competitor in the financial system. Invoices, especially in our countries, have grown a lot, trying to make a small term financing much easier through, probably working capital financing through, invoices that actually are small run financing that can be made through the capital markets. So, and finally, I think everything needs to be done, and we have to improve our institutions. I think institutional economics is something that we need to develop, because we have the difference between the institutions has a huge role in determining the long run growth in a country. If we don't have that in all our economic models, we have to introduce how institutions are actually working. And those are things that is probably the difference between Latin America and emerging Europe. Is because our institutions are weak and are ineffective. So we have to work on them. And it's not only making policies, it's how these policies are applied in the country. And that's, I think, the most important thing if we want to be able to fight this pandemic more. So, and in institutional economics, I have to say there is a huge room for political transaction costs. Without politics, it's impossible to understand how effective an economic policy can be implemented. So those transaction costs in politics have to be taken into account whenever we design any fiscal or monetary policy in the quarters to come.
Thank you very much, Claudia. Very useful comments too. Very interesting, your views coming from the private sector as president of the Stock Exchange of Lima. So probably we can start this conversation together with the coordinators of the macro report and Teresa and you, probably talking about the role of the private sector. As you mentioned, Claudia and Teresa, there is a limited role for the public sector in the years ahead. So probably the private sector should take that leading role for the recovery. So what can we do? What will be your recommendations to improve and to get a much faster recovery?
Is the question for me or for Teresa?
Yeah, for both of you.
So I think Teresa should start, and I will complement.
Okay. Well, first of all, Claudia, nice to see you again, and it has been very interesting to hear your remarks. I agree with most of what you have said, but I have a little bit of a different view as regards the role of or the scope for taxation, for efficiency-friendly taxation ahead. I mean, frankly, I don't believe that Latin America should even try to reach tax burdens of the level of the OECD countries. I mean, we all know that the level of per capita income is an important determinant of how much tax effort a country can make. But I still think that in countries like, including Peru, there is plenty of scope for improving the tax, for raising or for mobilizing revenue, let's put it this way, in a efficiency-friendly way. For one thing, for example, property taxation is completely unexploited in the country. I mean, the tax base is riddled with, particularly for the income tax, is riddled with exemptions, and also there is a possibility of finding new sources of revenue, including, for instance, green taxes that could be used, including at the regional level. So I think that it's to me it's inevitable that down the road the tax burden is going to have to rise, and this is being recognized even in countries like the US now. That this pandemic has made it clear that there is a role that cannot be issued by the public sector in ensuring more sustainable, environmental friendly, and equity friendly growth. And this needs financing. It cannot be financed simply with debt. I mean, debt right now is relatively cheap, even for the emerging markets in an historical perspective, but it's not always going to stay so. So there is going to need to mobilize more revenue from in ways that do not eliminate the incentives for the private sector to produce and to make profits. I mean, of course, I will not speak because I leave it to you. They know much better than me the scope for mobilizing private financing for the investment, particularly in infrastructure at all levels of government. But I think there again there is clearly a role for the private sector. I would like to make one more point regarding taxation. The elimination of, for instance, excessive or distortive tax incentives and the exemptions is actually efficiency friendly. It improves it makes the more level playing field among companies, and it allows profits to flow more to the companies that are actually more efficient. So I think that, this also argues for scope for combining efficiency and growth and higher revenue mobilization.
Perfect. Thank you, Teresa. Claudia, your turn now.
Yeah, well, I will start with the role of the private sector, and I think that will depend a lot on the policies in each of our countries. We are debating, if you see what's happening in Peru, we are facing an election on Sunday, and that will depend on who is the next, who the next political tendency will be in power since July. Chile is debating itself whether the private provision of public services is probably going to change in the near future. Colombia is facing a new tax probably reform in the quarters to come. So the role of the private sector is being actually currently defined in many of our countries. That will depend on how politics go. We all know that we need the private sector to make a recovery of this pandemic. That's reasonably, and reason tells us that has to be. But whenever you see what's happening in many of our countries, there's still a huge call for increasing the role of the public sector in trying to confront the consequences of this pandemic. So we'll have to fight politically if we want to actually get reason to win. We need the private sector to grow if we want to finance a larger public sector. There's no way the equation can go without that. So let's see what happens in many of our countries, and we're currently defining which is the equilibrium that is going to be for the next probably 4 or 5 years. So let's see what happens. And after the election, I think we can have a proper view of how the private sector is going to be inserted in the new economic model of our countries. Actually, what Teresa said was something I agree with her a lot. Regarding property taxation, for example, I agree more. I cannot agree more. The problem is not necessarily how you design the policy, it's how you implement it. And there are many issues that we have to address before we apply a proper policy. First, the government capacity. Usually, property taxes are being managed by local governments. And local governments in many of our countries are not, they are very complex policies that they have to probably manage. So how are they going to deal with that? How are they going to determine what's the proper tax that has to be charged for that? I think that's the major complication, not necessarily the design of how are we going to tax the property. For informality is also a huge thing. In many of our countries, how you determine what's the value of your property? We don't have that data. So what is the tax we are going to apply for that if we don't have the information, the basic information we need in order to apply a proper tax? And the third thing which I think is very important is confidence. And many of that taxpayer, that includes me, whenever we face a state, we have no idea how we are going to end up paying, because we pay something and then we start to litigate with the state for many years. And that's because we are not clear. Whenever we don't know exactly what are we being charged for, it's very complicated that we don't try to avoid those taxes, because there is a higher tax than the one you don't know. And it's something that in our country that lack a lot of information, that we don't know many things, it's very complicated to design a proper policy. So simplicity is something that is going to take longer to design than a more comprehensive and complicated tax policy.
You're right, Claudia. And talking about the trust, we are working on it, and we're preparing a flagship to be released this year. So we're planning to have better assessments and good policy recommendations too for that regard. We are running out of time, but I would like to take at least a couple of questions from our audience and probably a reaction from Andy and Eduardo. So let me take one question from Raul Fuentes. He said, I perceive that one of the strong assumptions on which the report is based is the hope that vaccination will stop the pandemic. However, scientists around the world are warning about the possibility of a new pandemic occurring on top of the current one due to the new COVID-19 variants. If this happens, how does this change the scenario for the recommendations that the IDB is proposing in this report? Andy, Eduardo, any thoughts?
Sure, I can say something, Eric. Thanks. First of all, let me thank also Teresa and Claudia for the excellent comments. And if there's time, I'd like to respond to a couple, but let me respond to this question. So, I mean, it's a very good question, and we definitely thought about this a lot as we were writing the report. And so that is a little bit, the thinking behind the question is a little bit what we had in mind when we developed these more negative scenarios. So we do have negative scenarios where, you know, one interpretation of that is that the vaccine rollouts are delayed, or that there are mutations which are somehow vaccine resistant. I mean, I think one has to keep this in, you know, in perspective. The good news at the moment is that most of the vaccine, in fact, I think all the vaccines that have been approved have proving to be pretty good against the variants that we know about. It may reduce the effectiveness in terms of contracting the disease, but I think the evidence to date is that the effectiveness on serious disease and death is extremely good. So I think the vaccines that we have available at the moment are all extremely effective against serious disease and death, even for all the, you know, the new variants that people have been detecting. But of course, I mean, the concern here is that the longer the disease is around, then, you know, the possibility is that new variants will emerge. So we have thought about this, and of course it's a serious concern, and it will have important, you know, effects on growth and on the recovery and all of the other variables. So it's something that we'll have to keep monitoring as we go forward.
Thank you, Andy. Eduardo?
Yes, no, nothing. I completely agree with Andy. Nothing to add on that end. I also want to thank Claudia and Teresa for the very, very thoughtful comments. I would like to use 30 seconds to comment on two of them, one from each. On Claudia, I couldn't agree more with your assessment regarding the need to think about the supply chains more generally, you know, and think about the domestic and the external side of supply chains. And the analogy I like here is the analogy of leveling the playing field for all the participants in the productive process, no, those that exports and those that they do not. And I think that's something that we need to work on in Latin America a lot. And I think formalization is part of the equation, as you correctly point out. That's why I think it's very important, and we highlighted it in the presentation, this idea of thinking, for example, about how we can work in terms of formalization through the tax system, changing the paradigm from subsidizing informality to subsidizing formality, actually. That's why I like a lot the idea of the income tax credit as an instrument. And I hope today in the presentation in our closed chief economy session, my colleague Carola Pesino will focus on that, because she has been working on that a lot. On Teresa, just a very, very brief comment. I totally agree on your comment about productivity and the determinants of productivity. The point we wanted to stress here, and I think it's a critical point to make in the context of this discussion, is that, you know, coming out of this crisis, it's very important to raise the productivity level of all sectors, but there are some sectors that are better capable of achieving that. And one of them is infrastructure, because it's a critical element or intermediate input, if you will, the services of infrastructure that are used in all other economic sectors. That's why we also put so much emphasis in improving infrastructure, investing in infrastructure. Not only in this report, we also have the flagship on infrastructure we published last year. So very much the idea there is to work on the productivity levels of the whole economy. That's it. Thank you very much.
Thank you, Eduardo. I'm going to take only the last question, and we'll try to answer that one. Is from Arturo Porsekansky. He said, are the IDB's lending priorities aligned with your recommendations? Yes, they are completely aligned. And this is a complementary, I would say, flagship to the Vision 2025 that we released in our annual meetings in Barranquilla, Colombia. And President Claver Carone was focused on 5 priorities. One is related to regional integration, the other one to digitalization, the third one is about the small and medium enterprises, the fourth about gender gaps and diversity, and the last one about climate change. So all the recommendations that are in our macro report are completely aligned to the lending priorities of the Inter-American Development Bank. With that, we have to finish. So thank you very much again, Teresa. Thank you very much, Claudia. We need your thoughts, so probably we're going to contact you again to have a discussion, a deeper discussion on those topics. And thank you very much to the coordinators of this macro report. So thank you again, Andy. Thank you again, Eduardo. And we'll see you in a couple of minutes because we have a session with the Minister of Finance of Latin America. So thank you very much again. Bye-bye.
Thank you.